Hi, everyone. Thank you for joining us today for our webinar, Structuring NCUA Insurance Coverage. My name is Kelly Blount, and I'm the Program Marketing Specialist here at General Electric Credit Union. We're so glad you've joined us as we have a lot of great content ahead, and we wanted to thank you all for tuning in from the comfort of wherever you may be today. Before we get started, please note this meeting is being recorded. By attending today's webinar, your attendance is agreement in being included in our recorded session. I'd like to start with a couple housekeeping items. If you've joined us before, you know how things go, but if you're new to our webinars, welcome. As we all know, technology can sometimes be finicky. If we run into any issues, please bear with us and keep in mind we are recording today's webinar. So with that, let's get into it. To reduce background noise, all attendees are automatically muted upon joining. Should you have any questions, please use your question feature in the attendee panel to submit your question. If you're on a computer or smartphone, there's a drop-down located in the lower right corner. For the sake of time, we may not be able to answer every question, but we will reach out to you after to ensure your question is answered should we not be able to get to it in our time today. Additionally, after today's webinar, you will receive a pop-up that takes you to a survey. Your feedback is very important to us as we continue to expand our webinar program, so please take a quick moment to provide us feedback on how things went and what you'd like to see for next time. As I mentioned, today's webinar is being recorded and will be shared to our events page in the coming week. You'll be able to view this webinar as well as all previous webinars on demand on our events page. And with that, I'm going to turn this over to Lauren Dunbar, Vice President of Business Development here at General Electric Credit Union, to introduce herself and take us through today's topic.
Good morning. Thank you so much for joining us today. My name is Lauren Dunbar, Vice President of Business Development, and I'm so excited you have joined us to talk about NCUA insurance coverage. So, what is the NCUA? The National Credit Union Administration, commonly referred to as the NCUA, was created in 1970 and is an independent agency of the United States government that regulates, charters, and supervises credit unions. The NCUA manages what is called the National Credit Union Share Insurance Fund, which insures the accounts we are going to discuss in detail today. The first thing we have to look at when confirming NCUA insurance coverage is the accounts that may or may not be included within this coverage. The included accounts are share accounts, also called savings accounts, share draft accounts, also called checking accounts, money market accounts, and share certificates. Some of the accounts that are not included within this insurance coverage are things like mutual funds, stocks, bonds, and life insurance policies. To truly assess insurance coverage, we really have to go into 4 different types of ownership categories. If a person has more than $250,000 at any single credit union, we have several options available for additional coverage, which is what we are going to talk about in detail today. On this slide, you see a brief overview of how to calculate that coverage. But again, it truly comes down to these 4 types of ownership categories. Those categories are individual accounts, joint accounts, trust accounts, and retirement accounts. We will go into quite a bit of depth on each of these ownership categories, and I will be providing examples as well. Please remember that each situation is different, and to determine your own personal insurance coverage, you will want to use the resources we will talk about at the end of this webinar. The first ownership category we are going to talk about is single or individual owned accounts. The NCUA provides $250,000 of insurance coverage for these single ownership accounts. In the example provided, member 1 and member 2, who are spouses, each have an individual account containing $250,000. As you can see in the sample calculation on the right-hand side, the $500,000 total is insured because member 1 has an insured balance of $250,000 and member 2 has the same. It is important to note in these calculations that this is cumulative and not necessarily per account. For example, if I have an individual money market account with $200,000 and I also have an individual certificate with $50,000, the full insurance coverage is $250,000 because it is cumulative based on this ownership category. The next ownership category we are going to discuss is joint or multiple ownership accounts. Joint accounts are defined as being owned by two or more people who have equal access to withdraw the funds. For this ownership category, we are going to assume that there are no named beneficiaries on the accounts. We will get into beneficiaries a little bit later. Each joint account owner in this category has $250,000 in coverage. As the example provided, member 1 and member 2 maintain a joint account and each also holds an individual account. The interests in the joint account are separately insured from the interests in the individual account. Based on the calculation shown here, each member would have $250,000 in insurance in their individual account and $250,000 of insurance in their joint account with a combined total insured balance of $1 million. I want to reiterate that this calculation is also cumulative. The number of accounts that you have within each ownership category does not matter. It is the similarly categorized accounts that are added together cumulatively to determine the coverage. The third and probably most complicated type of ownership under the NCUA is revocable trusts. A revocable trust account for insurance purposes is an account owned by one or more people, identifying one or more beneficiaries who receive the funds upon the death of the owner. When looking at this ownership category, there are really two types of revocable trusts we're talking about. We're talking about informal revocable trusts, which are also often called payable on death or POD accounts, or what we might think of as formal revocable trusts, also known as living trusts that actually have an associated trust document. But again, for purposes of insurance coverage, these types of accounts are accounts owned by one or more people, identifying one or more beneficiaries who receive the funds upon the death of an owner, whether that's a formal trust account or an informal trust, such as a payable on death account. They fall under the same category. Also within this ownership type, there are multiple calculations within this category. As an example, if a revocable trust names 5 or fewer beneficiaries, the calculation is as follows. You would multiply the number of owners multiplied by the number of beneficiaries, and that you would multiply by $250,000. As an example shows, member 1 and member 2 are the owners, while there are 3 named beneficiaries. The total amount cumulatively insured in this example would be $1,500,000. As another example, with the calculation being multiplying the number of owners by the number of beneficiaries and multiply that by $250,000, if there is 1 account owner and 5 named beneficiaries, the coverage would be $1,250,000 based on the explained calculation. An even more complicated calculation is involved when there are 6 or more different beneficiaries listed. Even further within 6 or more beneficiaries, the determination is based on whether those beneficiaries have equal or unequal beneficial interests. For example, if there are 9 beneficiaries with an equal interest in the funds when the owners pass away, that could provide up to $2,250,000 of maximum insurance. We are not going to go too much further in depth into these calculations because they're very specific to each situation and how many owners and beneficiaries are involved, and even further, what interest those beneficiaries have. When talking about revocable trusts, it's important to understand just a few more things. The owners of a formal trust, when there's a living trust or an actual trust document associated with those accounts, the owners of a formal trust are often called the grantors. And that for the purposes of calculating insurance coverage, the trustees and the successor trustees really are not relevant. The trustees are the administrators of the trust, but they do not have impact on the insurance coverage itself unless they are also grantors or owners or beneficiaries. It is also important to note for formal revocable trust agreements that beneficiaries are considered the people or the entities who are entitled to the interest in the trust. Therefore, contingent beneficiaries are not taken into consideration for coverage purposes since they do not have an interest in the funds while the primary beneficiaries are still living. Once again, revocable trusts are certainly the most complicated in calculation, but I hope that this was just at least in understanding that there are certainly quite a few ways to increase the insurance coverage beyond the $250,000. The fourth and final ownership category is retirement accounts. Retirement account insurance is again separate and apart from the insurance coverage in the other ownership categories. For purposes of retirement accounts, also called IRAs or individual retirement accounts, traditional and Roth IRA accounts are aggregated together and insured up to $250,000. It is important to understand that adding beneficiaries to individual retirement accounts does not increase the insurance coverage in this particular category. You will see in the example provided that member 1 and member 2 have a joint account with $500,000. Member 1 also has a retirement account with $250,000. The total insured amount for these members is the complete $750,000 balance. As an extended example, if member 1 and member 2 had a joint account with $500,000, member 1 had a retirement account with $250,000, and member 2 also had a retirement account with $250,000. The complete $1 million balance would still be fully insured. The next thing we're going to go over are resources. So we've talked a lot about what accounts are covered, what ownership categories. And so the question probably is, what does that mean for me? Are my funds insured? What does the ownership on my accounts look like? And there's many different resources that we have for you. The resources we like to give our members is mycreditunion.gov and NCUA.gov. On mycreditunion.gov, all of those calculations that you've seen in the slides today, those are actual calculations from mycreditunion.gov. There's calculators, there's pamphlets that go into great detail regarding the coverage. We've also provided here a phone number and an email directly to the NCUA. They are happy to talk to you about your insurance coverage. And of course, we are also here as your credit union to answer any questions you might have regarding the particulars surrounding your direct insurance coverage. As we talked about today, there are many ownership categories, many factors that play a role into this calculation. What I discussed today was just examples. There's a lot more detail we can go into. There's a lot more assessment when looking at actual specific accounts and determining whether those funds are insured. And of course, we would be happy to look at your specific situation in order to give you a greater peace of mind. On the next slide, you will see my contact information, and I absolutely welcome any specific questions that you might have. At this time, I will pass it back to Kelly, who will review some of the questions that have surfaced during our conversation.
Thank you, Lauren. As Lauren mentioned, we will now open it up for Q&A. So if any question came to mind during the presentation, go ahead and submit that using your question feature. We did have a couple questions that were pre-submitted as well, so we'd like to make sure we get to those. Please note today's Q&A session will focus on generic questions regarding NCUA insurance. All account-specific questions will be held and you will be reached out to independently offline in regard to your account-specific question. We do still encourage you to ask any questions you may have. So with that, we'll go ahead and jump into the first question. I will actually take this one, Lauren. The first question that was asked was if this webinar is being recorded. It is recorded and will be hosted on our event page as well as our YouTube page in the coming week. So you'll be able to take a look back at the content we discussed today through the recording. Again, that will be held on our events page as well as our YouTube page. Our next question is, does NCUA insurance coverage include all accounts like IRAs, CDs, savings, and checking accounts?
That is correct. The covered accounts included, again, are savings accounts, checking accounts, money market accounts, and certificate accounts. And things like IRAs, the individual retirement accounts, are actually part of the ownership categories, but yes, those are insured.
Our next question is the money market at GECU federally insured?
Absolutely. Money markets are insured by the NCUA and included within that insurance coverage.
The next question asks, is the NCUA a federally insured program?
It is. The NCUA, National Credit Union Administration, is an independent federal agency, and they are the agency that administers what's called the National Credit Union Share Insurance Fund, and that is the fund that revolves around all of the coverage that we discussed today.
Our next question says, I was interested in the amount of coverage provided. I understand that it is $500,000 per account.
The coverage is truly dependent on actual ownership category. And again, the ownership categories are individual accounts, joint or multiple owned accounts, trust accounts, and retirement accounts. And that coverage can vary quite a bit based on how the accounts are structured themselves, who the owners are, who the beneficiaries are, what that interest looks like. So coverage is not necessarily based on each individual account, but it is cumulatively based on each ownership category.
Our next question says, can insurance coverage be increased by depositing funds with different federally insured credit unions?
So as we kind of talked about in quite a bit of detail, the true easiest way to increase insurance coverage is to look at the ownership and see if accounts can be structured in a way with owners and beneficiaries, see if they can be structured in a way that provides additional insurance beyond the $250,000. We do recommend utilizing resources such as mycreditunion.gov and ncua.gov to determine insurance coverage with different institutions.
Our next question asks, what share insurance coverage exists after a member passes away?
The death of a member does not affect the share insurance coverage for a period of 6 months following death, unless the accounts are restructured before that time. Basically, if the accounts are restructured or that 6-month period expires, coverage will then be provided based on actual ownership of any living individuals on the account.
Our next question says, do I have to be a credit union member to be insured at that federally insured credit union?
The answer to that question is truly it depends, and it depends on the ownership category. For example, for joint accounts, only one joint owner or co-owner has to be a member for insurance to extend according to the rules we talked about today. However, for revocable trust accounts, all of the owners must be members. So that answer is really determined based on the ownership category.
And then our next question is asking, can you explain what a revocable trust account is?
Yeah, absolutely. So in terms of the revocable trust account category, There are two ways to really think about that. What we might normally think about is kind of the formal revocable trusts, also known as living trusts. So that is where there's a trust document associated with it. There are creators of the trust called grantors. There are trustees who administer the trust, and then there are beneficiaries who benefit from the funds in that trust. So those are certainly included in that revocable trust category. However, also included in that revocable trust category are informal revocable trusts, often called payable on death accounts. So truly what this category, ownership category, encompasses is an account that is owned by one or more people and identifies one or more beneficiaries who receive the funds upon death. So it's not necessarily just that formal revocable trust. It's also that informal option with an account that has named beneficiaries.
All right, and it looks like that was our last question. There's a couple questions that we will reach out to you directly to answer your question offline. So that is going to conclude our Q&A for today. Lauren's contact information is up on the screen, so if any questions arise after today's webinar, feel free to reach out to Lauren to have your questions answered. I do have a couple closing comments before we end today's session. Once again, you will immediately see a survey after today's webinar. Please fill that out on how you thought today went, as your feedback is very important to us. And then lastly, up on the screen, you'll see a list of our upcoming webinars. If any of these topics are of interest to you, you can visit our events page or capture the QR code with your smartphone on the screen to take you there directly. There you'll be able to learn more and register for our upcoming events. And we are always adding more, so if these topics aren't of interest to you, definitely be sure to check back soon. But with that, that concludes today's webinar. Thank you all for joining us and have a great rest of your day.